Hi, in this lecture, we are going to see the risk-neutral method of valuation, which, like we discussed, was the last method, which is called as the risk-neutral valuation or the expectations approach. Before we actually go into the risk-neutral valuation, let's actually revisit a small concept that we learned as part of the second part to lecture 1. Any financial asset, for that matter, is measured using the standard discounted cash flow technique. What is the standard discounted cash flow technique? It's basically that the value of an asset is the present value of all the future cash flows that are generated by the asset discounted at the required rate of return. For instance, if you want to value the bond, what you essentially do is you take the present value of all the future cash flows in case of a bond being coupon, and the redemption value that you get at the maturity. You discount these cash flows at the required rate of return. Required rate of return is nothing but what you as an investor want as a return when you're investing in that bond. In case of share, what you do is you take the present value of all the future dividends that you receive from the share, and of course at the time of once your horizon period ends, the sale proceeds also is expected to be realized, and you discount those sale proceeds to today's terms. In case of an option, if you apply the same concept, the value of an option is supposed to be the present value of the future payoff that you receive from an option. Now think of a binomial model. If you remember in our example, we had a share whose current price was 50. The share could go up, otherwise I'll just bring the example on the screen. So we had a current share price of 50. The share price could go up either to 55 or it could fall down to 45, which means, talking from a call options perspective, the payoff of the call option could have been either 7 or it could be 0. If you try to apply the discounted cash flow technique to option valuation, then the value of the option is supposed to be the present value of the expected cash flows from the option. Expected cash flows is nothing but either 7 or 0. And you know that when you have two possibilities or multiple possibilities, you basically take an average of those possibilities, right? You calculate the expected cash flow. Expected cash flow is going to be nothing but an average of 7 and 0. And then you discount it to today's terms. But then we saw that there was a problem in applying the discounted cash flow technique, which is nothing but the application of required rate of return or the determination of required rate of return. Required rate of return by concept should basically be a reflection of the riskiness of the cash flows involved. What do we mean by that? When you're discounting a bond, basically you have coupons and redemption value. Both of them are actually certain. They're contractual generally, right? So there is no uncertainty with regard to the fact as to what the coupon will be or what the redemption value will be. The only uncertainty is whether the other company will actually be able to pay the coupon without actually defaulting on the coupon or the redemption value for that matter, right? But there is no uncertainty with regard to the amount of coupon or redemption value. With regard to a share, you actually are estimating dividends, but the actual amount of dividends that the company pays may actually deviate from what you are expecting. Similarly, the sale proceeds that you are estimating at the end of your horizon period could be completely different from the actual market price that would prevail once your horizon period gets over, right? So there is a lot more uncertainty in estimating dividends and shares. And that is the reason there is since there is more risk when in determining the cash flows of a share versus compared to a bond, the discount rate for a share is always higher than the discount rate of a bond. The fundamental principle is the discount rate that you use must reflect the riskiness of the cash flows involved in the cash flows or your estimates. Coming to option has its own estimate, its own risk characteristics. If you actually see, the option cash flow is not certain. The option cash flow is uncertain because there are two possibilities, right? It could be either 0 or it could be 7. This is in a binomial model. In a real world, obviously there could be the share price at t equal to 6 could be anything, right? I mean, binomial model, we assumed that the share price could be either 55 or 45. Whereas in real world, the share price can have any possible number from 0 ranging to, I mean, theoretically you can call it to infinity, but of course, a 50 rupee share price or a $50 share price cannot go up to infinity in 6 months, right? So of course it's going to have an upper bound as well, but theoretically talking, you can say infinity. right? So a share price is actually not certain at t equal to 6. So obviously your option payoff is determined on the basis of share price. For example, in case of a call option, it's going to be, your payoff is going to be the difference between the share price prevailing on the maturity date less the strike price of 48. That is how we arrived at 7. But of course, it cannot be negative. It's going to be restricted to 0, right? So when your option payoff is uncertain, of course, your discount rate also should reflect the uncertainty in these cash flows, right? It cannot be, basically, you cannot use a risk-free discount rate. For instance, in case of a zero coupon bond which is issued, or a treasury bond which is issued by the government of India, you actually use the risk-free rate because those cash flows are certain. You know that the government cannot default. Therefore, you do not even add any default risk. Whereas over here, the discount rate should basically have a risk premium in addition to the risk-free rate. But we saw that there is actually no model which has been formed which actually captures the risk premium for that is required by an investor of a call option. The CAPM, or the arbitrage pricing theory that you would have learned, is applicable only for shares, and the risk characteristics of shares is not the same as the risk characteristic of options, right? So basically, we do not have a model currently which captures the risk preferences or the risk aversion of the investor of a call option or a put option. Okay, and therefore we resorted to alternative methods, and those alternative methods were nothing but what we saw over here. Under the delta hedging approach, we basically created a risk-free portfolio and then valued the option. Under portfolio replication, we said that the call option can be replicated by a certain portfolio, and the price of that portfolio is the price of the call option or a put option. Now we are moving to risk neutral valuation. Risk neutral valuation actually applies the discounted cash flow technique, but then it makes one additional assumption, and that assumption is with regard to the discount rate that needs to be used. I'm just quickly moving on to the relevant slide. Yeah. So firstly, this is actually the easiest way to solve in the examination. So if there is no specific mention of a particular method that needs to be used, you will always use risk neutral method because it's very, very easy. It does not have any complexities of delta or anything that you learned earlier. Okay. So this is, you will be using this approach to solve any sum in the examination, provided the question is not specific about any particular method. Now coming to one additional method, additional assumption that this method takes. If you remember, the binomial model assumes makes two assumptions. One, that the share price does not change between today and the maturity of option, which means the share price does not change between t equal to 0 and t equal to 6 in our example. And the second assumption it makes is the share price can only take two possible values, either 55 or 45, right? So these two assumptions were common to all the three methods of binomial model. The risk neutral method makes an additional assumption, and that assumption is that the option is being valued by a risk neutral investor. Who is a risk neutral investor? An investor who actually doesn't care about risk. There are basically three types of investors. You would have probably read this in portfolio management. Even if you have not, it's okay. I'm just summarizing it for you. There are basically three types of investors: risk averse investor, risk neutral investor, and risk lover. Okay. I mean, the market is always filled with risk averse. What does risk averse basically mean? It means that if you are taking a certain risk, you want a higher expected return from the asset. Again, remember, I'm saying you want a higher expected return. I'm not guaranteeing you that the actual return you will get from a risky asset is going to be more than what you will get from a normal asset. Okay. I'm saying that the return that you at least expect before entering into the, before buying that share or before buying that instrument should be higher, right? Why? Because see, if there are two assets, asset A and asset B, or let's say, you know, there are two banks. One is the RBI and the other is, say, Lakshmi Vilas Bank, which has just defaulted. Okay. So, which is, I mean, defaulted meaning it's virtually on the, it is actually not defaulted. It's virtually on the brink of bankruptcy, and it's now getting merged with another bank. Okay. RBI is obviously the safest one. Okay. Of course, I know that you cannot lend money to RBI, but hypothetically, let's say that you're lending and borrowing from RBI. Okay. RBI is very, very safe. Lakshmi Vilas Bank is not so safe. Okay. RBI is offering you an interest rate of 7%. Lakshmi Vilas Bank is also, let's say, offering you an interest rate of 7%. Which one would you prefer? Obviously, you would prefer RBI, right? Reason being, the 7% that RBI is saying is guaranteed. It is guaranteed. It's going to repay you. If you deposit 100, it's going to repay you 107 after 1 year. Whereas if you place your money with Lakshmi Vilas Bank, there is a certain element of doubt. Of course, in Indian history, never, a bank has never defaulted, but hypothetically, there's obviously a doubt. Okay. So if Lakshmi Vilas Bank has to, induce you to invest your money with it, it has to offer you a higher rate of return. So Lakshmi Vilas Bank will say offer 10% return, 10% interest to you, and that additional 3% is actually, it is alluring you to actually invest with Lakshmi Vilas Bank, and that 3% is a risk premium that Lakshmi Vilas Bank is willing to pay to you. Okay. So you over here were actually a risk averse investor, because before investing in Lakshmi Vilas Bank, you wanted an additional return of 3%. Otherwise, if both of them were actually offering the same return, you would have gone to RBI because RBI was less risky. Okay. A risk neutral investor, in this case, in the case example of a Lakshmi Vilas Bank or RBI, a risk neutral investor would have not bothered because he is neutral about risk, which means he doesn't care about risk. He's going to ask the same return from all type of assets, whether it's RBI, whether it's Lakshmi Vilas Bank, whether it's a share in Reliance, or whether it's a share in any trash company. He's not going to bother about risk. He's going to basically ask a single rate of return. The third is actually a risk lover. A risk lover basically pays a premium to take risk. For example, a most common example that's given is people who go on in the rides in amusement parks. They are actually risk lovers. They pay for the ticket and then they actually take risk of losing their life because they enjoy doing that. Okay. The market is filled with risk averse investors. Whenever you actually want to invest in any asset, if you think that the asset is actually risky, what you will do is you will bargain a lower price for that. And with that lower price, your return actually increases, right? Your expected return actually increases. So if you believe that an asset is risky, you ask a higher premium or a higher expected return from that asset. How do you ask a higher expected return? By quoting a lower price. Okay. Now in option valuation over here, we are making this third assumption in risk neutral method, that the option is actually being valued by a risk neutral investor. Okay. And why are we making this assumption? Like I said, it's basically to dodge that problem that we had with discount rate. A risk neutral investor always actually expects the risk-free rate of return. Okay. So like I've written over here, if we assume that the investor is risk averse, then we actually do not know the discount rate that needs to be used. To dodge that, we basically use risk neutrality assumption. Okay. And what is the implication of risk neutrality? The required rate of return for any risk neutral investor is actually the risk-free rate itself. And obviously the risk-free rate is known. We did not know the discount rate before when we assumed that the option was being valued by a risk averse investor. Reason being, we were not able to calculate the risk premium that he needs for investing in an option. Whereas if you assume that the option is being valued by a risk neutral investor, we know the discount rate or the required rate of return, because the required rate of return is nothing but the risk-free rate. Okay. So a risk neutral investor expects a risk-free rate from all the assets. He doesn't care about whether an asset is more riskier or less risky. Okay. So the required rate of return for a risk neutral investor is risk-free rate. Okay. Is it correct to actually assume risk neutrality? Because like I said, the marketplace is actually full of risk averse investors, right? So if I go and buy an option, I know that the future cash flow is actually uncertain. Okay. So my required rate of return is actually not going to be the risk-free rate. But now in this option valuation method, I'm actually assuming that the discount rate or the required rate of return is the risk-free rate. Is that a correct assumption? Meaning, if I value an option, assuming that it is being valued by a risk neutral investor, will that value of an option actually hold good in the risk averse world? Risk averse world is the real world in which you and I operate, right? So will the value of option in the risk neutral world be equal to the value of the option in the risk averse world? The answer is yes, it is going to be equal. There are two logics that I can give. One, I can prove it to you mathematically. How am I going to do that? I will show you that the option valuation, or the value of an option that you have got under the risk neutral method, is actually the same as what you have got under the previous two methods, which is the delta hedging and the portfolio replication. Under portfolio replication and delta hedging, we did not make any assumption of risk neutrality, right? But in this method, we have made this assumption of risk neutrality. And if the value of the option under risk neutrality equals the value of the option under the other two methods, obviously it means that the risk neutral valuation is going to be applicable to the real world as well, right? Because in delta hedging and portfolio replication, we valued an option as if it was the real world, right? If the value under the risk neutral method is equal to the value under the other two methods, one way of understanding it is the assumption of risk neutral investor valuing an option does not impact the premium that we have calculated. The second method, the second way I will be proving it is, I will give you a logic as to how the numbers will change if you actually assume that a risk averse investor is actually valuing the option instead of a risk neutral method. Okay. So firstly, let's go into the core technique of risk neutral method. So like we saw, risk neutral method is an extension of the standard DCF. Under the risk neutral method, what we actually say is the value of an option is the present value of expected payoff discounted at the required rate of return. The required rate of return, like we saw, is the risk-free rate. Why is it the risk-free rate? Again, because it is valued by a risk neutral investor. Okay, I will be repeating this time and again because that needs to sit in your head. Okay, the discount rate is actually risk-free rate only and only because we are valuing it as a risk neutral investor. Had we valued it as any other investor, the discount rate is never going to be the risk-free rate. Okay. So now if you observe, I'm using the word expected payoff, right? Why have we used the word expected payoff? I already gave an answer, because there are in binomial model, there are two possibilities of cash flows, or two possibility of option payoff. One, I could have a payoff of $7. The other, I could have a payoff of $0. And whenever you have two possible payoffs, you basically find an expected payoff, which is going to be a number between 0 and 7. It's an average number, and you discount this average number by using the risk-free rate to arrive at the value of an option. So when I said the average, does it mean 7 plus 0 divided by 2, 3.5? The answer is no. Okay, because I have never in the previous lectures mentioned that the probability of 50 going up to 55 is 0.5 and 50 coming down to 45 is 0.5. I have never made this statement. I have never spoke about probabilities at all. Okay, I just said that I just said that the share price may go up to 55 or 45. I never tried to indicate that the possibility of each of those nodes is actually 0.5. Okay, the possibility of upper node could be anything. The possibility of downside movement could also be anything. The only condition is upside probability plus downside probability should obviously be equal to 1. Okay, because there is no third possibility, right? There are only two possibilities, and the sum of these two possibilities should actually be equal to 1. Okay, now we then move into finding out the probabilities. Okay, so to calculate expected payoff, you need the probability of the share price going up and the probability of the share price going down. Okay, generally if I ask you to calculate probability of a share price going up and share price going down, what we generally do is we basically try assigning some probabilities based on past data and based on your expectations of how future is going to be, right? For instance, if you believe that this company is going to do extremely well in future, maybe you might say that the possibility of going up from 50 to 55 is higher. If you expect the company to perform poorly, you will say that the probability is going to be higher on the downside movement. Okay, this is your expectations of future. You can also look at the past data and assign some probabilities, right? So probability is generally a judgmental thing in case of a share market, because the share price could actually move either ways, right? I mean, even if you expect the company to do extremely well, you will still give a probability of a downside move, because the share market can move either ways, right? So over here, are we going to actually assign probabilities? The answer is no, because assigning of probabilities is done by you and me as a risk averse investor, whereas we want the probabilities that are assigned by a risk neutral investor. Now, how the hell are we actually going to find out the probability from the mind of a risk neutral investor? Okay, that is what we are going to actually see in the remaining part of this video. So I've not created any spreadsheet for risk neutral valuation. I thought it would be better if I actually put it down in the form of, if I write it down basically. So I'll just move to the whiteboard. Yeah. Okay. So taking our example, basically we had strike price of 48. I'm using a different software. So pardon me with that. We had the current share price of 50. It could go either up to 55 or it could come down to 45. All right. Remember, now place yourself as a risk neutral investor. You are no longer that risk averse investor. You are a risk neutral investor. Okay. Now let's say the probability of upside move is P, and the probability of downside move, I can write it as Q, but obviously P plus Q should actually be equal to 1, right? Because there are only two possibilities. So instead of writing it as Q, I'm just writing it as 1 minus P, because I know that this plus this should be equal to 1, right? So the probability of upside move is P, the probability of downside move is 1 minus P, okay? If the current share price is actually 50, and now think of it as if I'm valuing a share, okay? Forget option. First, let's come to valuation of share, okay? If the current share price is actually 50 and the future share price can only be either 55 or it can be 45, then you actually know that the share value of 50 is nothing but the present value of future share price. Okay, here there is no dividend. Okay, there is at t equal to 6, there is only the future price of share, right? So you know that the present value of the share price today is nothing but the present value of the share price, which is going to prevail as at t equal to 6, right? So if I write this, 50 is equal to present value of 55 into P. This is going to be the expected share price, right? Plus 1 minus P into 45. Okay, this is actually 50. Give me a second. I will. Yeah. Okay. Because why have I written this equation? Because the share price today by discounted cash flow technique method should be equal to the present value of the future cash flow. What is the future cash flow? Future cash flow could be either 55 or 45, right? So obviously I again have to take an expected future cash flow over here. Expected future cash flow is going to be nothing but 55 into P plus 45 into 1 minus P. For instance, if let's say hypothetically P is equal to 0.6 hypothetically, then it will be 55 into 0.6 plus 45 into 0.6. I think my mouse is not moving. Yeah. Okay. So it will be 55 into 0.6 plus 45 into 0.4. Sorry. I think I said 0.6 earlier. Okay. So that will be the average share price. I don't know. It will be some number between 55 and 45. And the present value of that should be 50, ideally, right? Again, when we discount it, when we are bringing it from t equal to 6 to t equal to 0, we again need a discount rate. What is the discount rate? The discount rate is going to be the risk-free rate, because you are a risk-neutral investor. A risk-neutral investor not only needs a risk-free rate for option, he needs a risk-free rate irrespective of the instrument he is investing in. whether he's investing in a bond, whether he's investing in a share, or whether he's investing in an option, or whether he's investing in any other instrument, house property, anything, he only needs his required rate of return is risk-free rate. Okay, the risk-free rate, I think in our example was 5% per annum. Yeah, sorry, give me a second, guys. Sorry, the whiteboard basically vanished. Apologies. Okay, so the risk-free rate is actually 5% per annum. Okay, which is equal to 2.5% for 6 months, right? So over here, basically, it is when I take the present value, it is going to be at 2.5%, right? Okay, now let's solve for P. Okay, now that we know what the expected share price is, which means that it could be either 55 or 45, and the present value of the share price is 50, let's actually solve for P over here. And then we can calculate, we can basically plug in these P values in the upper node and the bottom node. It's going to be 50 is equal to 55P plus 45 minus 45p the whole divided by 1.025. Okay, and which is nothing but 10p plus 45 the whole divided by 1.025. All right. Apologies, guys. There was some issue that I was facing with the previous software, and that is the reason you actually see the change in color. So just to again pick up, we saw that the risk-free rate was 5%, which was 2.5% for 6 months. The current share price is 50. We said that it could go either up to 55 or down to 45. The probability of going up is P. We denoted it by P. The probability of it going down is obviously 1 minus P, because there are only two situations. The sum of these two must be equal to, the P plus 1 minus P should be equal to 1, right? Obviously, the upside probability plus the downside probability should be equal to 1. Okay. And then what we said was, we as risk neutral investors, we placed ourselves as risk neutral investors. We see a share price of 50 today. Okay. This share price of 50 should be equal to the present value of the future cash flow, of the expected future cash flow. Future cash flow over here is the share price at t equal to 6, because there is no dividend. We have not assumed any dividend, which means dividend is equal to 0. So the share price of 50 from the viewpoint of a risk neutral investor should be the present value of the expected future cash flow discounted at the required rate of return, where the required rate of return for me as a risk neutral investor was nothing but 2.5%. Right? So then we equated LHS and RHS as 50 is equal to the present value of the expected cash flow. Expected cash flow being 55 into P plus 1 minus P into 45, which is the downside. So we get an expected cash flow which is lying in between 55 and 45. Okay. And we discount this using a discount rate of 2.5%. Okay. When we solve for this further, we saw that 55P plus 45 into 1 minus P divided by 1.025, that in turn comes into this equation of 50 is equal to 10p plus 45 divided by 1.025. Remember, in the denominator, it is 1.025 because of risk neutral assumption. Okay, so please understand that the reason we have used 2.5% in the denominator is because we have assumed risk neutrality. Had we not assumed risk neutrality, the denominator, which is nothing but the discount rate that we are applying, would have actually been something else. Okay, before I describe what that something else is, please note that what we are discounting over here are the cash flows of a share. Okay, not the cash flows of an option. Okay, because the equation that we have written is the current price or the today's price is equal to the present value of the future cash flows. Okay, and the present price that we have taken is that of a share. Okay, 50 is the current spot price of a share. Okay, we have equated that with the present value of the expected cash flows arising from a share. The expected cash flow arising from a share is nothing but the expected sale proceeds at t equal to 6. Okay, because there is no dividends, it's only the share price which is moving. So it is the expected sale proceeds at t equal to 6, where the expected sale proceeds is nothing but 55 into p plus 45 into 1 minus p. Okay, you discount these expected sales proceeds with the risk-free rate, because we have assumed that you are a risk-neutral investor. Okay, had we not made that assumption, the discount rate that we would have used would have actually been the CAPM discount rate, because when we are discounting the cash flows that are arising from a share, we know that the discount rate that needs to be used for discounting the cash flows from a share is nothing but CAPM for a risk-averse investor, right? Because for a risk-averse investor basically wants a premium for entering into the share market, right? So he needs RF plus an additional risk premium, which is captured through beta into RM minus RF. Therefore, his discount rate becomes the CAPM discount rate. Agreed? So these are the cash flows of a share, which we are discounting using the risk-free rate, because we have assumed risk neutrality. Had we not made that risk neutral assumption, the expected cash flow would have remained the same. It would have been 55 into P plus 1 minus P into 45. That is the expected cash flow. Okay. But for a risk averse investor, the discount rate changes. The discount rate is actually CAPM. Okay. Now you might be actually wondering that I said that we do not have a model to discount the cash flows, right? But now I'm saying that CAPM can be used. Earlier I said CAPM should not be used, all right? But remember, I said that we do not have a model to capture the discount rate to discount the cash flows of an option. Okay, I never said that we do not have a discount rate to capture the riskiness of a share, right? I mean, these are the expected cash flows from a share. We obviously have a model to discount the cash flows that are arising from a share, and that model is nothing but CAPM or APT. Okay, so there are basically, I'll just summarize it. There are two discount rates that we're talking about. One is a share, okay, and the second we're talking about option. Okay, sorry, the second that we're talking about is the discount rate for an option. Okay, so there are two discount rates. When will you use the discount rate for a share? When you're discounting the cash flows arising from a share, the relevant discount rate is that of a share. When you're discounting the cash flows arising from an option, the relevant discount rate should be the discount rate for an option. Okay, now if I actually write down share, okay, we know that there are two types of investors. I'm not talking about risk lovers over here. Let's talk about risk neutral and risk averse. Okay, there could be a risk neutral investor. The other, there could be a risk averse investor. A risk neutral investor, his required rate of return when he is buying a share is nothing but the risk free rate of return. Okay, when a risk neutral enters the share market to buy a share, his required rate of return is actually risk free rate, and that is the reason we have actually used the risk free rate over here, because we have assumed the risk neutral, I mean the person valuing the option is a risk neutral investor, right? So he needs the expected sale proceeds. His required rate of return on this share is actually 2.5%. That is the reason we have used 1.025 as the discount rate. Okay, for a risk averse investor, his required rate of return would have actually been CAPM. Okay, if a risk averse investor would have been doing the same exercise that we are doing over here, he would have discounted the expected sale proceeds with the CAPM discount rate. Okay, not with the risk-free rate, because he knows that he is entering into an instrument where the cash flows are not certain. The cash flows could be either 55 or 45. Remember again, I'm talking about share cash flows, right? The share cash flow could be either 55 or 45, which means the share cash flow is not certain. There is an element of risk involved in it. And therefore, when he's discounting the expected sale proceeds, he will need a risk premium. Okay. So his discount rate is not going to be just 2.5 percentage. To this 2.5 percentage, he will be adding a risk premium, which is nothing but beta into RM minus RF. And he will be using that particular rate to discount the cash flows. Okay. Here we can actually proceed with this step even if we would have not assumed risk neutrality. We would not have faced the roadblock over here. The real roadblock is when we are going to discount the cash flows arising from an option. Okay. So after share, later on, we are going to discount the cash flows that come from an option. Okay. If I just write it down, the cash flow from a share is either 55 or 45. All right. I'll just cash flow from share. Okay. Now I am now talking about the discount rate that needs to be used for discounting the cash flows from option. Okay. This can be either 7 or 0. Sorry guys, give me a second. Apologies, sorry, give me a second. Okay, so when we are discounting the cash flows from an option, the cash flow from an option where the cash flows could be either 7 or 0, this step we are actually going to see, where we will actually discount the cash flows from an option. For a risk neutral investor, again, we could have two situations. A risk neutral investor is valuing and a risk averse investor is valuing. Okay. If we are assuming that risk neutral investor is valuing, the discount rate is going to be RF. Again, okay, because the risk neutral investor requires only a risk free rate of return, whether he's investing in an option or whether he's investing in a share. Okay. Whereas for a risk averse investor, the riskiness of an option is not the same as the riskiness that is there from the risk aversion that he has from an option is not the same as the risk aversion that he has from a share. Okay. So for a share, we have a model which is able to capture his risk aversion, and that model is CAPM, or you could have even APT. Okay. Although CAPM is more often used, we could also have APT. Okay. But we do not have a model over here to discount the cash flows arising from an option. Okay. Here we do not know what discount rate needs to be used. Okay, so we would have faced a roadblock actually over here. Okay, but when we assume risk neutrality, we have a convenience that the required rate of return is nothing but the risk-free rate of return. Okay, so what I'm basically trying to say is that we would not have faced the roadblock. We would not have faced the roadblock when we at this step, even if we would have not assumed a risk neutral investor. That is, even had we proceeded assuming ourselves to be a risk averse investor, we would have continued with this step. The only difference being, when we are discounting the expected cash flows from a share, for a risk averse investor, the discount rate is not 2.5 percentage, it would be the CAPM discount rate. Okay. For now, just remember that the denominator is 2.5 percentage only because we have used the risk neutral assumption. Otherwise, it would have been the CAPM discount rate. Okay. And it would have been the CAPM discount rate because we are discounting cash flows arising from a share. Okay. Had these been the cash flows arising from an option, then CAPM is not the discount rate. We do not have a model to capture that discount, that riskiness of cash flows from an option. Okay. For now, just remember that the discount rate is actually 2.5 percentage or the risk-free rate because we assumed risk neutrality. Otherwise, it would have actually been something else. All right. So then when we solve for this further, we get 50 into 1.025 is equal to 10p plus 45. All right. Which means I'm just solving for this. 50 into 1.025 is 51.25. That equals 10p plus 45, which is nothing but 10p is equal to 6.25, which means p is equal to 0.625. What does this mean? This means that the probability of upside of up move is equal to 0.625. So obviously the probability of down move will be 0.375, right? The probability of down move, which is 1 minus p, is going to be 0.375. Obviously, right? Okay. Are these the real world probabilities? The answer is no, because the real world probabilities are those probabilities which are assigned by risk averse investors like you and me. But now what we did was we placed ourselves as risk neutral investors. We placed ourselves in the shoes of risk neutral investors, and then we backed out the probability. Remember, we did not assign the probability. We have backed out the probability using the above equation, which means these probabilities are the probabilities that would have been assigned by risk neutral investors, which means risk neutral investor has basically assigned a probability of 0.625 to the upside move and 0.375 to the downside move. These are not the probabilities that risk averse investors have assigned. Okay. So if you again go back and see, what we actually did was we backed out the probability. We did not assign any probability. You and I as risk averse investors have not assigned any probability. We stepped into ourselves into the shoes of risk neutral investors. We then thought that if I was a risk neutral investor, the required rate of return for me on this share is 2.5%, right? Therefore, if I discount the future cash flows, if I discount the expected future cash flow by 2.5%, I need to get the present value of the share today, the current share price today. Okay, because value of any asset is the present value of the future cash flows. For me, the discount rate or the required rate of return on the share is 2.5% for 6 months. Okay, so then I equated this. I said 50 should be equal 50 should be equal to the present value of the expected share price at t equal to 6, where the expected share price we calculated as 55p plus 45 into 1 minus p, where p is the probability of up move and 1 minus p is the probability of down move. Okay, we then actually backed out. Okay, we calculated probability. Okay, this probability that we got as 0.625 is actually nothing but the probability that a risk neutral investor would have actually assigned to an upside move. Because only if the upside move's probability is 0.625 and the downside probability is 0.375, then the expected cash flow will be such that the return that a risk neutral investor earns will be equal to 2.5% for 6 months. I will just repeat myself. Only if the probability is 0.625 on the upside and 0.375 on the downside. Okay, let us actually calculate what the expected cash flow here. It is 55 into 0.625 plus, or rather let me write plus over here, 45 into 0.375. Okay, that is going to be, you guys can also calculate it at your end. This is going to be 51.25. Okay, this 51.25 that we calculated is actually the expected share price at t equal to 6. Okay, when I'm saying that the share price can be either 55 or 45, and I've given you probabilities of what the chances of the share moving to 55 and 45, the expected share price is an average or a weighted average, not a simple average, between 55 and 45, which I've got as 51.25. Okay, the simple average is 50. Simple average meaning I've assigned equal probabilities, but I have not assigned equal probabilities. I believe that the probability of, I as a risk neutral investor believe that the probability of it going up is more than the probability of it going down. Therefore, I assigned a higher probability to the upper side. and I have an expected share price of 51.25. Okay, this 51.25 is nothing but what we actually got in the LHS side over here. Okay, now only if the share price is 51, if I expect the share price to be 51.25 at t equal to 6, then my return that I earn, the return that I earn from if I buy a share today and if I sell the share at t equal to 6 at an expected share price of 51.25, then my realized rate of return will be 2.5 percentage. Okay, 50 into 1.025 is nothing but 51.25, right? So what I've actually done is, having known this 51.25, I actually backed out these probabilities. So are these probabilities the real world probabilities? Absolutely not. The real world probabilities can be anything else. It could be actually 0.5 and 0.5. Real world probabilities could be 0.7 and 0.4, zero point 0.3. It could be anything else, 0.8, 0.2, etc. Okay. But these are the risk neutral probabilities. Risk neutral probability basically means the probabilities that have been assigned by a risk neutral investor. Okay, we have calculated these probabilities by backing them out from an equation. Okay, but in reality, I mean, or theoretically, if you think of it, these are the probabilities that have actually been assigned by a risk neutral investor. We do not know how he has assigned it, but we have actually calculated it from this equation. All right. So the probability or the risk neutral probability, therefore I will actually never utter this as just probability. It is always, I attach it to, uh, I mean, I have a rider to that probability saying that this is the risk neutral probability. Similarly, on the downside as well, this is the risk neutral probability. Okay. These are not the real world probabilities. I'm time and again stressing on this fact because sometimes the question might not be clear, and sometimes ICAI has actually distinguished in a question between real world probability and risk neutral probability. Okay, if they give you the real world probability and the risk neutral probability, and then you're asked to find the value of an option, you are supposed to use the risk neutral probability and not the real world probability. Okay, so we have seen that the risk neutral probability is 0.625 and the of the upside, and the risk neutral probability for downside is 0.375. Okay. Now I'm again just drawing the same binomial tree. 50 could go up either to 55 or it could come down to 45. Okay. And then we have an upside probability of 0.625 and a downside probability of 0.375. Okay. These are not the real world probabilities, an upside risk neutral probability of 0.625 and a downside risk neutral probability of 0.375. And then we had the value of a call option at upside being 7 and at the downside being 0 at t equal to 6. Okay, this is at t equal to 6. We saw that the value of call option could be either 7 or it could be 0. How? Because we had a strike price of 48. Okay, so on the upside, I have a payoff of 7, which is equal to 55 minus 48. On the downside, since the share price is less than the option strike price, I have a payoff of 0. Okay, now what I do is I find out the expected value of a call option, not from the viewpoint of a risk averse investor. I find out the expected value of a call option from the viewpoint of a risk neutral investor. Okay, the expected value of a call option, sorry. So the expected value of a call option is equal to 7 into 0.625 plus it is 0 into 0.375. Obviously, the latter term is going to be 0 because 0 multiplied by anything is 0, right? Okay. 1 second. Give me a second, guys. I'm again facing the issue that I had faced earlier. Give me a second again. I'm sorry for this disturbance. Yeah, okay, it's fine now. So it's 7, the expected value of a call option at t equal to 6 again Okay, I'm finding out the expected value of call option at t equal to 6 as 7 multiplied by the risk neutral probability plus 0 multiplied again by the risk neutral probability. Just like how we calculated the expected share price at t equal to 6, we are now calculating the expected value of a call option. When you have two values of a call option, what you do is you basically weight it by the probability of that of the event occurring, where over here it is 0.625 and 0.375, which is nothing but 7 into 0.625 is 4.375. Okay, this 4.375 is not the expected value of a call option from the point of risk averse investor. It is the expected value of a call option from the viewpoint of a risk neutral investor. The reason being, the probabilities that we have used over here are that of risk neutral investor. Okay, 7 and 0 are going to be the same for every investor, whether he's a risk neutral investor or a risk averse investor. The 7, which is the payoff from the option, 7 and 0 are going to be the same, whether I am viewing it as a risk averse investor or a risk neutral investor. The thing that is actually going to change is 0.625 will not be 0.625. Sorry for this. Yeah, 0.625 will not be 0.625 for a risk averse investor. 0.375 will be something different for a risk averse investor. Okay, the moment I multiplied the payoff of a call option with risk neutral probabilities instead of real world probabilities, the expected payoff or the expected value of call option that I calculated at t equal to 6 is the expected value of a call option from the viewpoint of a risk neutral investor, which is 4.375 in this case. Okay, had I used real world probabilities over here in the numerator over here at both point, instead of 0.625 and 0.375, what I would have got would have been the expected value of a call option in the real world, which is from the viewpoint of a risk averse investor. All right, but I've not done that here. Okay, let us go ahead now. This is the expected value of a call option at t equal to 6 from the viewpoint of a risk neutral investor. When a risk neutral investor is investing in an option, he needs a risk-free rate of return, right? Because whether he's investing in a share or whether he's investing in an option, all he needs is a risk-free rate of return, because every instrument, all he needs is RF, okay? Therefore, the value of call option today, the value of call option at t equal to 0, which is today, is a standard DCF definition, which is nothing but value of a call option today is the present value of the future cash flow discounted at the required rate of return. What is the future cash flow? Expected future cash flow is 4.375. Okay, the future cash flow can be either 7 or 0. We found out the expected future cash flow, which is a number between 0 and 7, by multiplying it with the respective risk neutral probabilities. Okay, so the expected future cash flow is 4.375. I discount that with the required rate of return. What is the required rate of return? For a risk neutral investor, the required rate of return is 2.5%. Therefore, I discount it by 1.025. If you look at it, 4.375 divided by 1.025 is nothing but 4.268, which is approximately 4.27. Okay. Now the question is 4.375. We said that it is the expected value of a call option for a risk neutral investor. The discount rate, which is 2.5%, is again the discount rate for a risk neutral investor. So obviously the value of call option that we get, this 4.27, should be for a risk neutral investor, right? But then we said that the value of call option that we actually get over here of 4.27 holds good for risk neutral investor. It also holds good for a risk averse investor. Okay. And this, I said, there are two ways of proving. One is, if you have already observed, the 4.27 that we actually got over here is actually equal to the 4.27 value of a call option that we got under delta hedging approach and under the portfolio replication approach. Okay, under delta hedging and portfolio replication, did we make any assumption about risk neutrality? No, we did not assume a single thing about risk neutrality. In fact, we heard the risk neutral term for the first time over here. Okay, without assuming any risk neutrality, which means we were working in the real world. Okay, we were working in the real world in both delta hedging and portfolio replication. We got an option price of 4.27 for a call option. Okay, making an assumption of risk neutrality also, we got the same option value of 4.27, right? Which means without risk neutrality assumption also we got 4.27. With risk neutrality assumption also we got 4.27. Okay, therefore the assumption of being risk neutral actually does not impact the value of the option. The value of the option that you get over here holds good for a risk neutral investor as well as a risk averse investor. Okay, this is one way of proving it. The second way of proving it is, what will happen is, if let's say you are a risk averse investor. Okay, if you are a risk averse investor, the probability over here of 0.625 and 0.375 will not hold good for you. Okay, the reason being, these are the probabilities of that of a risk neutral investor. Okay, your probabilities are going to be different from these two. Okay, so what will happen is your numerator will actually go up. Okay, if you are a risk averse investor, the expected cash flow at t equal to 6 will actually go up, and so will your denominator, because for you the required rate of return is no longer 2.5%. You are a risk averse investor, which means you require a return which is more than the risk free rate. Okay, when will you actually ask for a risk-free rate? I mean, if you are a risk-averse investor, there is only one situation where you will ask for a risk-free rate: when the cash flow at t equal to 6 is actually certain. Okay, that is the only time when you actually ask for a risk-free rate, when it is certain and it is also default free. Okay, over here we are not talking about default risk, but there is uncertainty of cash flow. When there is uncertainty, the required rate of return for you will not be risk-free rate, it will be more than the risk-free rate. Okay, so therefore what will happen if you are actually thinking from the viewpoint of a risk-averse investor, what will happen is your numerator will go up, which is your expected cash flow will go up, and your denominator also will go up. Okay, in such a manner that the value of the option from a risk-averse investor's point is also 4.27. Can I actually prove it with numbers? No, I cannot, because the whole point we started off with was that I do not know what the discount rate should be. Okay, I do not know whether the discount rate for a risk-averse investor when investing in options should be 10%, 20%, 100%. I have no idea. There is no model so far, at least, which is able to capture the risk preferences or the risk aversion of an option buyer, right? So I do not know what the discount rate is. Okay, so that is the reason I cannot actually show you with numbers that had I increased this and also the denominator, that the value of the option would still be 4.27. I cannot show you that, okay, because I do not know what the denominator is. Had I known what the denominator should be, then we wouldn't have actually ventured into a risk neutral method at all, right? I would have straight away spoken about DCF, and we would have straight away found out the real world probabilities and then discounted it with the required rate of return, which includes a risk premium. But the problem is I do not know what the risk premium is. And that is the reason we ventured through the risk neutral route, wherein I assume that I'm a risk neutral investor. So as a risk neutral investor, I only require a risk-free rate of return. I then backed out the probability of 0.625 and 0.375. These probabilities are the risk neutral probabilities, which means that a risk neutral probability has assigned an upside move of 0.625 and a downside move of 0.375. And only when he does that, he will actually get his desired rate of return, which is nothing but the risk-free rate. If he assigns any other probability, then he would not get his desired rate of return. Okay. And then what I did was I calculated the expected value of a call option. Okay. And then the value of a call option today is the present value of the future cash flow, or the future expected value of a call option. Okay. So the future cash flow was 4.375. I discounted it with my required rate of return, which is the risk-free rate of return. When I'm saying over here, I refers to I as a risk-neutral investor. Okay. Therefore, when I do that, I've got an answer of 4.27. And we said that this 4.27 holds good for a risk-neutral investor as well as for a risk-averse investor. One way I showed it was the 4.27 that we got over here was equal to the value that we got under the other two approaches, where we did not make any assumption of the risk neutrality, right? So that was a real world. This is a risk neutral world. Both of them at the end are giving you the same result. Okay, so risk neutrality does not impact, okay, it does not impact the value of the option. Can we actually proceed? I mean, if it does not impact the value of the option, can we proceed without that risk neutrality? The answer is no, because if you do not assume risk neutrality, the discount rate that needs to be used will not be 5%. It will be something else, right? Only for a risk neutral investor, the discount rate is 5%. Therefore, assuming risk neutrality is mandatory to in this approach. Okay. The second way I said it will hold good in the real world is, in the real world, if you actually want to do a standard DCF, what will happen is your expected payoff will go up and so will your discount rate, in such a manner that the value of the call option today is still going to be equal to 4.27. Okay, so I hope I've conveyed the message very clearly. In the next video, which will be a very short one, I will actually show that we can actually back out this discount rate. I mean, we cannot calculate the discount rate using model, but given the fact that the option is trading at 4.27, and we will calculate the expected payoff. I mean, I said over here that the expected payoff will actually increase, right? For a risk averse investor, we will calculate what that expected payoff should be. And then we will then back out the discount rate, and we will say that this is the discount rate that a risk averse investor is actually seeking for. Okay, that is not going to be relevant from an examination viewpoint for any three of the examinations that we are generally speaking about. It's not going to be important for CA final, CFA level 2 and FRM part 1, but it's more for you to get a thorough understanding. I will end this video over here. I hope you guys have understood. It's actually, and if you sit and solve sums, it's actually very, very easy, but there's a lot of logic behind everything, right? I mean, trying to understand what the risk neutrality actually means and so on. Okay, I hope you guys have understood. Thank you.